One company controls more money than the entire GDP of Japan, Germany, and the UK combined. It's not a government. It's not a central bank. It's a private firm most people have never heard of, BlackRock. BlackRock manages over $15.3 trillion in assets. That's roughly 1/7 of the entire world's yearly economic output. To put that in perspective, it owns at least 5% of most major public corporations in America. Apple, Amazon, ExxonMobil. That stake isn't passive. It comes with voting power, and voting power shapes how these companies are run. Since its IPO in 1999, BlackRock's stock has climbed over 7,500%. But the real story isn't the stock price. It's how a firm founded in 1988, with 8 people, became the most powerful investor on Earth in under 35 years. The answer is a piece of software called Aladdin. Built in-house, Aladdin runs Monte Carlo-style simulations to model how investments could fail before they do. As markets went electronic and computing power got cheap, BlackRock's tech edge let it scale faster than any rival, and it started buying up the competition. Merrill Lynch's distressed assets in 2006, Barclays Global Investors in 2009, a deal that handed BlackRock the iShares brand, now one of the most traded names in finance. But the real engine of BlackRock's empire isn't stock picking. It's something far simpler, the exchange-traded fund. ETFs let investors buy a basket of stocks in one trade at a fraction of the cost of traditional funds. BlackRock's S&P 500 ETF charges just 30 cents a year per $1,000 invested. That low cost combined with scale means index funds tracking the same market all deliver nearly identical returns, so investors flock to whichever charges the least. That's almost always BlackRock. Today, just 3 companies, BlackRock, Vanguard and State Street, control the ETF market. BlackRock alone holds roughly 35% of it. And when the financial system itself is on fire, there's only one company the US government calls. In 2008, the New York Fed hired BlackRock to manage the toxic assets of Bear Stearns and AIG. In 2020, as the pandemic crashed markets, the Fed brought BlackRock back, this time to manage trillions in corporate bond purchases. The firm's own annual report admits this closeness could trigger more regulatory oversight. Critics call it a conflict of interest, a private asset manager deciding which corporations get bailed out while also investing in them. BlackRock now markets itself as a champion of ESG investing. It helped push 3 board members out of ExxonMobil in 2021. But its own CEO admits the world's biggest polluters are state-owned enterprises, immune to Wall Street pressure. So the question isn't whether BlackRock has power, it's whether anyone, governments included, has the leverage to check it.